Since 2020, I saw the sell-off in 2022 as a prime opportunity to add to my positions. With a long-term view, I prefer to let investments compound rather than trade frequently, though others may take different approaches. This time I might take some profits for lifestyle reasons while maintaining the core position, given that this is the largest macro trade of all time, potentially extending through 2030 and beyond. It's important to pay attention as I explain why this is considered the most significant macro trade in history. I'll start with the Everything Code, a proprietary thesis from global macro investor that informs our portfolio strategy at Zant, where we invest in top hedge funds. This code highlights currency debasement as a central cyclical and forecastable factor in economic trends. Despite no model being perfect, this one seems to be proving accurate. Specifically, we've observed a declining trend rate in GDP growth globally, currently around 1.75%. This decline is influenced by three main factors: productivity, debt, and population growth. Productivity has decreased due to an aging workforce, while debt levels have risen and population growth has slowed, all contributing to the reduced trend rate of GDP growth.
Since 2020, the sell-off in 2022 was the exact opportunity I had been anticipating to increase my positions. From a long-term perspective, I believe it's best to let investments compound rather than frequently trading around market fluctuations. While some investors may prefer more active trading strategies, my approach is to take a more measured stance. This time around, I might consider taking some profits for lifestyle purposes, but I plan to keep my core positions intact. I view this as the largest macro trade of all time, one that could extend well beyond this current cycle, possibly into 2030 and even further. To illustrate why this trade is so significant, I'll begin by discussing the Everything Code, a proprietary thesis developed at Global Macro Investor, which forms the basis of our portfolio strategy at Zan. This thesis guides our investments in top hedge funds and focuses on the critical role of currency debasement. According to this model, currency debasement is cyclical and, to a large extent, forecastable. Although no model is perfect and circumstances can change, the Everything Code has been proving to be a reliable framework. A key observation from this model is the ongoing decline in the trend rate of GDP growth, both in the United States and globally, which is currently around 1.75%. This downward trend can be attributed to three primary factors: productivity growth, debt levels, and population growth. Productivity has been decreasing as the workforce ages, which impacts the trend rate of GDP growth. On the other hand, debt levels have been rising, further affecting economic growth. Additionally, slower population growth has also contributed to the overall decline in GDP growth. Understanding these dynamics is crucial for navigating the macroeconomic landscape and making informed investment decisions. This comprehensive view helps us anticipate future economic trends and strategically position ourselves to capitalize on the largest macro trade of our time.
Subscribe our channel and press the bell button to get our video notification. And like the video.
The correlation between the Nasdaq and the total liquidity index is remarkably high at 97.5%. This close relationship highlights how closely asset movements are tied to liquidity trends. The Nasdaq, in particular, outperforms due to a secular trend, but overall, the debasement of currency explains nearly all asset price movements over time, resulting in high correlations across various assets. While some assets may lead or lag, understanding this correlation is crucial. The underlying issue is that demographics are contributing to a slower economy. To address this, more debt is issued, and currencies are debased to stimulate economic activity and support asset prices. This approach makes asset prices rise despite the demographic challenges. This concept is central to what we call the Everything Code. A key aspect of this model is the Global Liquidity Index from major central banks, which is currently growing at an annualized rate of 8%. When factoring in global inflation, which we estimate to be around 4%, investors face a 12% hurdle rate. This means that to achieve real returns, investments must outperform this 12% rate to account for inflation and the cost of liquidity.
The correlation between the Nasdaq and the total liquidity index is strikingly high, at 97.5%. This strong correlation underscores how closely asset prices are tied to liquidity trends. The Nasdaq tends to outperform due to a secular trend, but overall, the debasement of currency explains nearly all asset price movements over time, leading to high correlations among various assets. While different assets may lead or lag in their responses, the fundamental driver is the availability of liquidity. The broader issue at play is the impact of demographics on economic growth. As the population ages and growth slows, there is an increased reliance on issuing more debt and debasing the currency to stimulate economic activity. This strategy is intended to counteract the effects of a slower economy and support rising asset prices. This framework is a crucial part of what we refer to as the everything code. A significant element of this model is the global liquidity index from major central banks, which is growing at an annualized rate of 8%. When we account for global inflation estimated at around 4%, the effective hurdle rate for any investment becomes 12%. This means that to achieve real returns, investments need to outperform this 12% hurdle rate to compensate for inflation and the cost of liquidity. Understanding these dynamics is essential for making informed investment decisions. The high correlation between the Nasdaq and liquidity measures illustrates how vital it is to consider global liquidity trends when assessing asset performance. Navigating this landscape effectively requires a solid grasp of these factors and how they influence the macroeconomic environment and asset prices.
When discussing cryptocurrencies, I often focus on Bitcoin because it has the longest price history and provides valuable insights. Bitcoin exhibits an impressive 87.5% correlation with global liquidity. Although this is slightly lower than the Nasdaq's correlation, it reflects periods of extreme outperformance, particularly during cryptomania cycles. These cycles, driven by Bitcoin's exponential growth and technological adoption, can temporarily lower its correlation with liquidity. Despite these fluctuations, Bitcoin's performance remains significantly influenced by global liquidity. Currently, Bitcoin is outperforming global liquidity by 105% annually. This is a staggering difference when compared to global equities, which are showing minimal to negative returns. This notable disparity underscores the potential of Bitcoin to enhance future purchasing power substantially. Understanding this relationship is crucial as it highlights why Bitcoin is such an important asset in today's market. Its strong correlation with liquidity and its extraordinary performance compared to traditional assets make it a key component for those looking to maximize their investment potential.
When discussing cryptocurrencies, I focus on Bitcoin due to its extensive price history, which offers valuable insights into its behavior. Bitcoin has a remarkable 87.5% correlation with global liquidity. This correlation is slightly lower than that of the Nasdaq, primarily because Bitcoin experiences periods of exceptional outperformance, especially during intense cryptomania cycles. These cycles are characterized by Bitcoin's exponential growth, driven by technological adoption, which can momentarily affect its correlation with liquidity. Despite these periods of outperformance, Bitcoin remains significantly influenced by global liquidity trends. Currently, Bitcoin is outperforming global liquidity by an astonishing 105% annually. This performance difference is striking when compared to global equities, which are showing minimal to negative returns. This substantial gap highlights Bitcoin's potential to substantially enhance future purchasing power, making it a crucial asset in the current financial landscape. The strong correlation between Bitcoin and liquidity, combined with its extraordinary performance relative to traditional assets, underscores why Bitcoin is such an important investment. Its ability to significantly outperform traditional equities and its sensitivity to liquidity trends make it a key component for investors seeking to maximize their returns. Understanding these dynamics is essential for grasping Bitcoin's role and potential in the broader economic context. I'll delve deeper into these aspects shortly to provide a more comprehensive view of Bitcoin's investment value and its place in the market.
Subscribe our channel and press the bell button to get our video notification. And like the video.